Hello and welcome to this video. In this particular video, we are going to take a look at the difference between fundamental and technical analysis. Now, as most of you know, these are the two basic schools of thought that are used to analyze stocks so that we can achieve the final objective of buying low and selling high, thereby making money in the stock markets. So in this particular video, we are going to cover a lot of things, and this is not just a difference video. I'm going to show you something really amazing at the end of the video. So stay till the end because if you miss that, you're going to basically miss learning something which is really useful in trading and can be really profitable. Let's take a quick preview as to what all we are going to cover in today's video. Let's first understand why fundamental and technical analysis came into being. So the stock market requires us to buy low and sell high, and we need some mechanism to analyze stocks so that we can achieve the same objective. So both these strategies have been established in order to achieve this objective. Do these strategies actually solve this mystery or not? We'll get to know, and what's the approach that they follow? We'll also get to know here. We'll take a brief look at what is fundamental analysis. We're also going to take a brief look at what is technical analysis, and then we'll delve into the main points of difference. We'll cover the difference in the approach of the two strategies, the data sets required, the applicability of the two strategies, and much more details. And we're also going to take as a look at the live trades which have been taken on both these concepts and how well have those trades performed. Are they good investments or not? We'll take a look at that as well. So we have lots to cover. Let's get started. Before we proceed, a quick look at the disclaimer. Whatever information I'm sharing with you is only for educational purposes. This is not any kind of trading or investment advice. So please do not consider any of this advice for your trading and investment decisions. I would request you to consult a certified financial advisor before you do the same. So let's first understand what is fundamental analysis. Now, as the name suggests, we basically pick up a company and we try to fundamentally understand whether that company is a good company or not. And this analysis can be split into two parts, a qualitative analysis and a quantitative analysis. In qualitative analysis, we are basically trying to assess all the things about a company which cannot be written down or calculated or represented by numbers. For example, if I want to understand how good or how bad the management of a company is, then I cannot assign a number to it. Okay, yes, different people can have different ratings, but then again, it's a conversion. It's because the quality of management of particular company is something which is qualitative in nature. You can't really assign you don't really have a number being produced. Anybody, if they try to assign a rating, a 4 star or a 5 star, then they're basically doing it based on their understanding, the qualitative understanding that they have. There's no number being generated as such. So whether it's a brand, whether it's management, goodwill, or innovation, the patents that a company may have, the value of those things can only be ascertained to a certain level of accuracy, because more or less these are qualitative concepts. So in fundamental analysis, one of the things that the analyst would try to do, the fundamental analyst would want to do, is to assess the qualitative nature of the company. Is it a good company? Does it have some competitive advantage which its competitors don't have? And is that competitive advantage going to exist for a long time, or is it something which is temporary? For example, if you consider technology companies, one of the things that goes really against them, which is not going to reflect in any numbers, is that technology changes very fast. So at one point of time, companies which were producing the magnetic tapes, which were the cassettes, were doing extremely well. Then all of a sudden, the compact discs came into play, and this technology disruption basically drove those companies to closures. And so this is one thing which is not going to come up in the numbers. These are risks, these are opportunities with the companies which are qualitative in nature, and so they have to be assessed separately. Then we get into the concrete numbers, which basically are nothing but information that is produced by the companies in terms of its balance sheet, the cash flow statement, the profit and loss statement, the insider selling and buying that happens. All this information has to be filed by the company with the SEC, so they need to publish these reports on a regular basis. And so these numbers tell us a lot about the internal operations of the company. So a fundamental analyst will try to pick up all these reports. He or she will try to run through all the numbers that are available, all the details that have been mentioned in the reports, and then try to make sense of those numbers. And a lot of times fundamental analysis is a relative analysis. You are not just trying to establish whether a company is good or not, but within a bunch of companies, 5, 10 companies that you have shortlisted, you're trying to establish which one is the best investment at the right moment. So this is what fundamental analysis is all about. you're basically trying to assess which companies are doing really well, which companies are expected to do really well in the future. They are being run by efficient managements and they are trading at a discount. So they are available for cheap, and that is what a fundamental analyst would try to do. So moving ahead, technical analysis, on the other hand, doesn't go into analyzing whether a company is doing well or not. All they are concerned about the fact is that there is market volatility. And what I mean by market volatility is that the best companies will see decline in prices, the worst companies will see an increase in price. In the short term, if you really think about it, no matter what your conclusion about a company's stock price is, they are going to have green days, days when the stock opened at a lower price and the price went higher. Same way for the worst companies, for the best companies, you will see that there is a decline in price. That means the price opened at a higher price and then moved down during the day, because stocks have volatility. No stock goes up in a straight line, no stock goes down in a straight line. So technical analysis, basically, the core concept here is that technical analysts feel that whatever good or bad information, news, sentiment is there about a company, that is already factored into the price, because the market is a very efficient system, and because the market is efficient, this information, as soon as it reaches the market participants, they will accordingly buy and sell, and the buying and selling pressure will decide where the stock price should go. So all the information, all the news that comes out is actually factored in right into the price. So there's no need to look at all the statements and carry out analysis and all that stuff. They basically feel that analyzing the price movement, the chart patterns itself, can give a lot of insight into what the company may do when the same pattern repeats. For example, the technician may feel that for a particular company, when the price hits $100, every time the price hits $100, there is a huge upward move in price. So what that means is that collectively the market feels that this company has a valuation more than $100, and whenever the price tries to reach $100, a lot of buyers step up and they start buying the stock. And is this behavior going to be a one-time behavior? Probably not. The chances are that at $100 price level, there are enough market participants who genuinely feel that this is an undervalued stock and they want to buy and have a long position in that stock, which again drives the prices up. So the market technician is going to basically try to use this information that the $100 price level is actually a support, and therefore when prices touch this support level, the market participants are going to come in and they are going to take the prices back up to, let's say, 120, 130 levels. And so the technical analyst is going to try to capture these gains between 100 and $120. So the primary toolkit of a technical analyst is going to be the charts, it is going to be patterns, it is going to be indicators. But to simplify this, technic the technical analyst is going to mainly depend on two things: the price and volume, because this is the only two sets of data that comes out of any exchange. They are not concerned about the financial statements, they are not concerned about the filings that the company is doing with the SEC. They are only concerned about what the price action is all about, and price action is only two values: price and volume data. So the technical analyst is going to try to anticipate what's going to happen in the future based on what's happened in the past for a particular company. Now let's get into the exact differences. And the first thing is the duration, which is basically nothing but the tenure of the trade or the investment that you're trying to make. Technical analysis is mostly used for shorter term trades. And the reason for that is very simple. Technicians want to look at uptrends and downtrends, and they want to look at stocks breaking resistances and breaking support levels, or holding support levels or holding resistance levels. So these are things which will continue in the short term. Obviously, a stock cannot be in an uptrend continuously for 3 to 4 or 5 years. So that can happen. I'm not saying that is not possible, but the technicians don't usually do that. When a stock is in an uptrend, then we can safely assume that for the next 2 or 3 months before the next earnings report is released, the stock is going to continue move upwards if there is a good sentiment around that company. And if the earnings is good, then maybe another 3 months. So technical analysis, technical patterns, they kind of hold true more for the short term investment, or the short term trades, I should say, not for the very long term investments. I mean, you would rarely find technical analysis being used for taking a trade for 20 years. because the 20-year trade is not going to depend so much on the chart patterns. It's more or less going to depend on the fundamentals of the company in which you are trying to trade. So technical analysis is basically towards the short term horizon, and the fundamental analysis is usually for the long term investments. Now technical analysis is used by people who are going in for fundamental investments to make more accurate entry points. So let's say somebody's trying to get into a position for a long term, 5 to 10 years, but uh, they want to take a position, and they don't want to be in a situation where they just take a position and the price falls by 10-15% against them. So they are confident that over a period of 5-10 years, that up downward move will be compensated by an upward move and the stock will finally make them profit. But the thing is that if a fundamental analyst feels that right now the stock is trading at a resistance level, then although they are bullish about the stock, they will wait for some time for the reversal to take place, for the stock to fall down in price. And so technical analysis here is not playing a role in the investment decision. The investment decision is already made based on the fundamentals. It's only dictating or helping with an exact entry point. So this is the difference between fundamental and technical analysis in terms of the time durations in which the trades are taken. Technical analysts usually take short-term trades. It can be from a couple of minutes, which basically is day trading, to a couple of weeks, a couple of months maybe. But for longer term trades, fundamental analysis is used. I mean, think about somebody who's an intraday trader, right? Within a single day, the fundamentals of a company are not going to change, and so it doesn't make sense for an intraday trader or for even a short-term swing trader who's taking trades with for 2 or 3 days to look at fundamental analysis, because for short-term trading, the fundamentals of a company, the underlying values of a company are not going to significantly change, and so that is not going to be the parameter which is going to drive up or drive the price down. It is more or less going to be the supply and demand, and that is reflected in the chart in terms of various patterns and candlestick formations that take place. So in short-term trades, the technical analysis is more useful, whereas for long-term trades, fundamental analysis is more useful. But even for the long-term trades, you can use technical analysis to make better entry points. The second difference is the underlying data set that is used by the fundamental analyst and the technician. So, as we already discussed, a fundamental analyst would need the balance sheet, the cash flow statement, the profit and loss statement, the filings, the different reports which are filed with the SEC, the report regarding the sector health. How is the sector in which a particular company which is being analyzed, how is that sector doing? How is the overall market doing? How is the macroeconomic condition, like the employment numbers, the GDP, the overall market condition, the currencies, how are they looking? So all this information is going to be analyzed by the fundamental analyst, and they will usually carry out a top to bottom approach. They'll basically try to look at the macro picture, study the GDP, the interest rate trends, the currency trends, the overall market bullishness or bearishness, and then they'll get down to a specific sector, then they'll get down to the specific company, and within that company they'll try to see the reports and balance sheets and different financial statements to come to a conclusion as to whether a particular investment is good or not. Once they know that a particular investment is good, then they would be using different models to come arrive at an intrinsic value for that company. And if the intrinsic value looks good, that the stock is trading at a discount, they would go ahead and make a purchase. On the other hand, in technical analysis, as I've already mentioned earlier, there are only two data sets, price and volume. So these are the only two data sets which are required to create a chart pattern. And in a chart, this is only two data sets which are coming out of an exchange. So somebody tells you that they are using RSIs and MACDs. These are only indicators which are basically calculations on the price and volume. There's nothing else there. So you can use the same price and volume data, apply hundreds of formulas and create hundreds of different indicators, but more or less they are using the same data set. So as far as data set is concerned, the technical analyst only uses price and volume, and then obviously a charting software which displays this data in the form of different types of charts that are available, and also calculates these indicators and displays them for analysis. So here we are looking at the process or the approach of the two methods. So as I said, a fundamental analyst is going to analyze the publicly available information, and they are trying to identify companies which have predictable businesses, which are easy to understand, which have competitive advantage, like they have patents for the next 10, 20 years, or they have some technology or some formula like Coca-Cola. They have a formula which is a secret, and nobody else can produce Coca-Cola with the exact same flavor because that is a highly guarded trade secret. So companies which have good returns, which have good cash flow, they have low debt, so there is less chance of going bankrupt and them running into financial troubles. And then obviously they have good management, because even if you give the best company for bad management to run, the company is not going to do very well. So once all these factors are positive for a company, that gets shortlisted, and then the different valuation models like the discounted cash flow valuation or the peer comparison valuation, these different models will be applied to arrive at an intrinsic value. So the objective of the fundamental analysis is not just to identify good companies. You don't want to buy something good which is very, very expensive. Obviously expensive things will be good, but the real trick here to make profit, as far as fundamental analysis goes, is to actually buy companies which are trading at a deep discount, but those are good companies. You want to buy good companies at a discount, not just good companies at a very high price. I have a complete video about fundamental analysis. I'll leave a link in the description to that. So if you want more details, you can actually look at that. It's basically a complete stock screener about fundamental analysis using the Finviz platform, and it also then tells you a lot of concepts about fundamental analysis. So that's a good video to watch. I'll leave a link to that in the description. And so once you identify these companies which are trading at a discount and are good companies because all the criteria is met, you basically make an investment into these companies. On the other hand, in technical analysis, basically you analyze charts, and these charts which you analyze, they will show different patterns, they will have different market cycles. So when you see a particular uh, breakout happening or a gap taking place, or when some trigger point is activated, the technical analyst is going to take a position and along with a stop loss, because the technical trader is trading in the short term, so usually these trades will have stop losses. On the other hand, the fundamental analysis analyst is investing, he is not trading, so the stop losses will usually not be there, because you have a long term horizon. And even if the stock falls 10, 15, 20% in the short run, the expectation is that in the long run, because the company is inherently good but undervalued, it should catch up to its valuation. So we are going to take a look at both these processes with a live example uh, in a bit. So, but we'll cover the differences first, and then we look at the example. The fourth difference between these two approaches is the returns that you can expect. The one thing is the duration of the returns. So when you are investing using fundamental analysis, you should not expect to get returns other than the dividends that get paid very quickly, because you're investing in the long term. So when we identify undervalued companies using fundamental analysis, then the idea is that our analysis suggests that the company is worth more, but in the stock market it is being valued less today, so it's trading at a discount. So we want the market to have enough time to understand and realize that this is an undervalued company and it should be trading at a higher price. Now that correction in price can happen within a week, or it can happen in 10 years. So there's no guarantee that the correction would happen immediately, or it would take a very long time to take place. But over a period of time, there is definitive proof that companies which are inherently good and they have been trading at a discount, the have finally caught up to their intrinsic value. And that is where the fundamental analysis has its roots, that you want to give enough time for the market as a whole to realize that a particular company is a good company, but it's being underpriced way below where it should be actually priced. And when the company when the stock price actually reaches that level, when the realization happens, then we want to capitalize on it. So this can happen in a long duration. And so the returns to be expected when using fundamental analysis should only be in terms of dividends, because dividends will be regularly paid out by most companies. But besides that, you should not expect returns. So returns can be 5 times, 10 times, 20 times, 50 times, but these kind of returns may happen over a long duration of 5 years, 10 years, 20 years, 30 years. So that's the time horizon for investments made using fundamental analysis. On the other hand, technical analysis, as we've discussed, are much shorter term trades. So because these are shorter term trades, in a short term, obviously you cannot make 5, 10 times the return. I'm not saying it's impossible, but that's not usually going to happen. So the target price is going to be at such a point where you will be basically looking to get somewhere between 5 to 30%. 30% is something where you basically get lucky and the stock really shoots up, but usually it's going to be 5 to 10%, maybe 15% returns within a month, 2 months horizon, which is a much shorter horizon and a much lesser return. So both of these trades, the techniques are different. uh, Fundamental analysis has a much longer turnaround time, and technical analysis has a much shorter turnaround time. So this is a example which, as I promised, we are going to discuss for the fundamental analysis. So the first thing, let's see, this is a stock which has a market capitalization of 3.310 million dollars. So this is the first key thing. Why is this stock fundamentally good? Consider a company which is already worth 50 billion dollars. How big do you think it can go? If that company has to make you 20 times the money, that company has to become a $1 trillion company, and it's tough to become a $1 trillion company. You cannot become a $1 trillion company very fast, very easily. So 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 this company is only worth $310 million now. That's its market capitalization. Now if I want to get the same 20 times return on this company has to become just a $6 billion company. So as far as I'm concerned, chances of this becoming a $6 billion company are way higher than the chances of a $50 billion company becoming a $1 trillion company. Returns on both these stocks are going to be the same, right? 20 times. But this is the first criteria, which is very good about this company, that the current market cap is low. It's not very small, it's not into the micro cap category, so that the share price becomes too volatile and this company runs out of cash very quickly. But at the same time, it's not that big that it has a lot of impedance, already grown by a lot of amount, and so in order to further grow, it really has to do something amazing. So this is one thing. Then second thing we see is the income. Now if you look at the income, one thing is very clear. Company which has a market cap of 310 million generates an income of 31.2 million dollars. That's about 10%. So every year this company is actually generating income which is 10% of its total valuation. So think about it. In 10 years, you would basically you would have generated earnings which are going to be equal to the entire value of the company that you paid for. Okay, so this is very, very good. Look at the sales. Sales are 50% of the current market capitalization, more than 50%. A lot of companies cannot do this. And let's proceed further. So this is the recommendation from the analyst, which is 1.9. Now this chart is from the Finviz platform. So if you see, 1.9 recommendation is somewhere between a strong buy and a buy recommendation. So the analysts are positive on this company. So we are not going against them. We are doing our own analysis, but at the same time, we are not going against the analysts. The P2E is under 15. So this is definitely not expensive. Price to earnings of 10.8 is good. It's not very high, it's on the lower side, and that basically tells you that this is not an expensive stock to buy. So moving further, you can look at the quick ratio and the current ratio, which is more than 1. That means this company has enough cash basically to meet its short-term debt obligations. So chances of bankruptcy and all that are not there. You see the long-term debt to equity and debt to equity, it is less than 1. So the equity is more than the debt. So that's also not a problem here. And now let's look at some more amazing numbers. The earnings per share or EPS for the last 5 years has been 18.5%. This is amazing because 18.5%. This particular number is really, really good. And more importantly, if you look at the sales are 26.5%. So in the last 5 years, this company has been doing really, really well. And the main figures, if you watch my video on the fundamental analysis, which I mentioned before, I'll leave a link to that in the description. The main thing is the ROA. So whatever assets the company has, this company is generating an ROA of 12.6%. What this essentially means is that whatever assets are given to this company, they are being well utilized. This company is generating a 12.5% return on the assets that have been provided to it, which is really, really good. The profit margins are also not very low. So it has some cushion here as well in case there is an increase in the costs that they have to incur, or some other they have to reduce the price. They have cushion there because their profit margin is high, it's not very low. So, and finally we look at the target price, which is 6.93. So it's not visible here, but this particular stock was trading at $3.20, around that value. So the target price is more than 2 times above the current price. So right now I'm not disclosing which stock this particular stock is, but I'll give that information in a bit. So this is about the fundamental analysis. Let's look at the technical analysis example. Now this is another company, and if you look at the chart here, this has a wonderful technical analysis setup. So you see here, this is a weekly chart, so it's multiple years, multiple months over here, and you can see here that the price came all the way down. It touched this price level, and then it touched this price level again, it touched this price level again, and every time the price comes to this around $3 level, you have these long candlesticks coming. So first thing is, it's a multiple bottom on a long term chart, and it's more in the last more than 3 years, this stock has not gone below $3. It just went for some time and it came back, but it stayed very close to $3. And another thing is, every time it starts reaching this price level, you see these long tails being forming uh, on the downside, which indicates that the buyers are trying to push up the prices. So as soon as the stock falls to $3 or close to $3, the uh, bullish players in the market, they come up and they increase the prices. So this is the same thing which is exactly happening here. It's not in a massive downtrend as well. If you consider this was a downtrend, but then it got arrested here, and now this is more or less like a sidewards move, and the downward move is getting arrested every time at $3. So as far as I'm concerned, this is a good technical setup to get in at $3 price level, and chances are if it goes to 4 also, you are making a 33% return. If it goes to somewhere around this level that it made here, around 4.5 5, then you can look at 50 to 60, 65, 67% return. And if it goes to its highest levels, then you can actually double your money. So again, this is a great technical setup, and I'm again not disclosing which stock is this one. The name was visible here. I have on purpose removed the name. So we have taken a look at two examples, right? And the real question now is, which of these techniques is better? We just saw an example where I showed you some of the fundamental figures on the previous uh, screen, and on this screen we are looking at a wonderful technical setup. So which approach is better? Which approach do we follow? Because from the explanation that I just gave, both of these uh, investments would look great opportunities, right? So the final thing that I promised in the beginning of the video, which is going to be amazing, is that successful investors actually create synergy. And synergy, what it means is that usually 2 plus 2 is going to be 4. But when you create synergy, 2 plus 2 is no longer 4, 2 plus 2 becomes 20. And that additional increase is coming because you have two factors which work together. So, what I would suggest to do is use fundamental analysis, use technical analysis, and combine both the strategies to create even much better results than what each of these strategies would create individually. The problem that most people face is that they try to put in too much of fundamental analysis, or they try to do too much of technical analysis, and that results in something called analysis paralysis. When you're bombarded with too much information, when you try to go too much in depth into something, it becomes overcomplicated and it becomes incomprehensible. So the easiest way to basically understand fundamental analysis and to make sure that instead of debating fundamental analysis versus technical analysis, or what is the difference between fundamental analysis and technical analysis, which one should I use, which is better, instead of having these questions, the approach that I would suggest to follow is learn fundamental analysis, use the basics, make sure that the company is basically fundamentally strong company, don't go very deep into it. Use technical analysis, make sure you're not going against the trends, you're not buying into a stock which is in a very very bad downtrend. So apply these both techniques and see where they converge. And I think you would have read on the slides by now, the stock that we saw earlier on the fundamental screen as well as on the technical screen was in fact the same stock. So now I have combined both the details here, and the stock ticker was BDSI. So if you see here on both, uh, with both the things available here, the stock is showing a great technical setup, and along with that, it has great fundamentals. So on this particular kind of a stock, the reason I'm saying that you should combine both the strategies or do something which you can call techno fundamental is that each of these strategies works because they are self-fulfilling prophecies. And what I mean by that is that a lot of people use fundamental analysis, right? So any company which becomes fundamentally undervalued, all those people are looking at the same data set, the same balance sheet, the same cash flow statement, the same income statement, the same filings that the company is doing with the SEC. So all the fundamentalists are trying to get into long positions in that stock, right? So when all fundamental people who follow fundamental analysis are going to get into long positions, there is going to be a natural pressure on the buy side, which is going to move the prices to the upside. So it becomes a self-fulfilling prophecy. Same way, a lot of people follow technical analysis. So when they see that the price of a stock is going to hit a long-term strong, very strong support level, they are going to start taking long positions over there, right? But imagine the power of the strategy if you can have the fundamental and the technical analysis aligned, as I have shown in this example, and then you have both blocks of people trying to go long in the stock. And when that happens, there is going to be a massive buy pressure which is going to get created, which eventually is going to move the prices to the upside. And so both these things are in themselves, they are self-fulfilling prophecies. But when they combine together, it really becomes a fulfilling prophecy, which is going to turn out in our favor. Another good thing about this is technical analysis. Let's say I the technical analysis in this case fails and the price falls down to $2.50. Am I worried about holding on to that investment? No. Why? Because I have checked the company fundamentally. Fundamentally, the company is now even more undervalued. So instead of worrying about the technical analysis breaking down and taking a loss, I would actually probably think about increasing my position size over there. So if you were only using technical analysis, you have no basis for you to continue in that trade because the technical setup has failed and you would exit that position taking a loss. But if you go into trades using technical analysis into companies which are also fundamentally sound, you don't have to worry if the technical setup breaks. If the technical setup works, fine, you make quick money. If the technical setup fails, it takes a bit longer, but then you're holding on to stocks which are really undervalued. So it's a win-win situation either ways. So with this, we'll conclude this video. I hope this was useful, and I hope you understand the importance of using both the concepts, not overcomplicating both these concepts with over analysis and over information. And I always say use that much fundamental analysis that you can understand. Use that much technical analysis that you can actually understand. So I hope this video was helpful. And if you like the video, please like the video. Please subscribe to the channel if you've not already done that, and please share it with your family and friends. And if you have any comments, any suggestions, you can leave them down in the comment section. I will definitely respond to you, and I'll see you guys in the next video. If you want any specific information or you want me to create any video on some specific topic, please let me know and I'll try to do that. Thank you for your time, and I'll catch you guys in the next video. Thanks.